right, welcome to podcast number 2. This is our second time doing this. We're very excited.
Yeah.
In our first podcast, which if you haven't heard, you should, we talked about entity formation, maybe where to register, how it all works, LLC, corporations, all that good stuff. We touched lightly on the benefits of an S corporation. Joseph kind of helped us go through the benefits of all that. So real quick introductions. I'm Jason Watson, Watson CPA Group, Amanda Rowles, and Joseph Bassett. Joseph is a tax professional for us in Pod C under Sally, and Amanda works in business development with me. So we are here today to talk about an S Corp election. Does it make sense? Typically it does, but we have to run through some questions, and we'll do that. And then Amanda is going to just take it away on how the heck we do this thing called S Corp election. 2553 is that your pin for your ATM?
Yeah, now everyone knows.
Yeah, you should
say
change
that on the podcast.
Exactly.
My voicemail pin.
Your garage code is 53. Watch it really is. You're like, oh, crap, I got to change it.
Phone code, it's everything. Yeah.
So we'll talk about that as well. And we'll also discuss late S election. I think that is really cool.
Yes.
We seemingly are one of the few people that know how to do it, it seems like. And we do a lot of them. We've been doing it for over a decade. So that's all good news. Joseph, can you just touch lightly on the benefits of an S Corp election? Talk about double taxation just a little bit, just to kind of refresh some of our viewers and our listeners on why it helps.
Right, yeah. So as a refresher, if you're just a garden variety LLC reporting your income on Schedule C of your 1040, you're going to be subject to 2 taxes. You're going to have to pay income tax, and you're also going to have to pay self-employment tax on the net income.
All 100,000, yeah.
Correct, on the net income from your Schedule C, and that can really hurt. So the S Corp kind of divvies that up some, and it takes that 100,000 and gives a portion of it to your reasonable compensation, and then you only have to pay that 15.3% self-employment tax, payroll tax, whatever you want to call it, on the portion that we deem to be your reasonable compensation. But you do still have to pay the income tax on all of it.
Okay. So to bring this home, what we're doing with an S corporation is we're essentially limiting how much income is going to be taxed at that secondary level, the secondary being Social Security and Medicare tax, right? We're telling the IRS what the new ceiling is on how much they can charge that additional tax, again, being self-employment tax.
Correct.
So, yep, all of it goes down to income tax, unavoidable, unless
you work less or spend more.
Work less or spend more. That doesn't sound like a good idea. All right. So, Joey, we on our website, which is WCGInc.com, check it out. We have a series of questions. And one of them is, does your business earn over $30,000 net income after expenses? Tell us why we ask that.
So we ask that one because it's, the savings are typically going to be 8 to 10%
at that income level.
Right, at that income level.
Yep.
They change with other income levels, and the cost to operate it at that income level, is going to be around, $27,000 to $3,000 to operate it. So that's just kind of where you're breaking even.
Okay. So when you say operate, I'll ask this to Amanda. Amanda, you do a lot of proposals
I do.
For clients who want us to help them administer their S corporation. So what is our general fee annually to help somebody administer their S corporation?
So our all-in package is roughly $3,000.
Okay, $3,000 a year, and that gives you what?
It gives you unlimited business consultation. It gives you your corporate and personal tax returns. We do quarterly S Corp payroll filings. We do tax planning. We do reasonable salary calculations. It's a whole host of excellent things for a business owner.
It is. So if you look at it, we're all in. It's going to be 3,000, like roughly 3,000. And again, this is 2019 for those of you listening. If you listen 20 years from now, it's probably going to be a little bit higher, maybe a few bucks more.
Right.
Just a few.
Yeah. Milk goes up. I guess we have to go up too. But anyway, your corporate tax return, your individual tax return, that's a joint filing if you're married. Of course, that's going to be in there too. We do your payroll events throughout the year. That also includes tax projections and planning. And Joseph does a lot of that right now here in quarter 3. because what we want to do is put you in a tax neutral position come next April. That's awesome. And then we also give you that unlimited consultation. So if you look at $30,000, $40,000, somewhere around there for your break even, and divide that by 0.9, 0.1, 0.8, whatever, you're going to get roughly $2,500 to $3,000. So we want to make sure that the S Corp savings is going to come close to covering some of the cost of having an S Corporation, and those costs being the corporate return, the payroll return, and all that stuff, or the payroll filings. The benefit still is, though, that even if you're paying somebody else now to do your tax returns, now you're basically using all your S Corps. Let's say you only made $30,000, right? You would still use all those savings and have to pay, let's say, for our fees, but you get all kinds of additional stuff. You get that unlimited business consultation. You get those tax returns now done. You get the planning and the modeling and all that stuff. So maybe you're not at that income of 30 to 35,000, maybe 40,000. You're not getting huge savings. You're having to spend most of those savings on the administration, but you do get extra value, or at least we like to think. Shameless promotion, self-alert.
So. Yeah.
All right. That's one question. Do you make enough where it makes sense? Okay. How about location? Talk to me about location. We ask, do you live in certain jurisdictions?
Right. Do you live in New York City, Tennessee, New Hampshire? What are some other ones?
That's about it. That's the biggies.
Those
Those
are
are
the
the big
major
ones.
ones.
Yeah. So, and if
New
you're
Jersey has a little bit of a corporate tax, but it's not as bad as New York City and Tennessee, New Hampshire. So tell us why those aren't good jurisdictions.
So those are poor jurisdictions because they don't recognize the S Corp election. To us,
Well, they do absolutely recognize it, and they tax the heck out of it.
right. They recognize it as a corporation.
No, they add on extra tax,
Right.
roughly 8%. Tennessee's 8%, New York City's 8%, like 8.25% versus 8.85%. I mean, it's high 8s to low 8s, meaning that all your federal tax savings that we just got done discussing are all wiped out.
Right.
Okay. So unfortunately, and again, New Hampshire, New York City, and Tennessee, they have this additional tax on S corporations, which wipes out the federal tax savings. Is there, though, an example of where being in New York City still necessitates being an S Corp?
Certainly, yeah. So in an LLC, you can't pay yourself a salary. So if we needed to optimize your Section 199A deduction and we needed to pay you a wage, then maybe the savings from the Section 199A deduction would help alleviate some of those taxes that you have to pay to New York City.
Yep. So just to give everybody a refresher on 199A, on Section 199A.
Yes, please.
Yeah. It is going to be 20% of your net business income or 50%. I'm going to just go ahead and correct myself. After you reach a certain income level,
Right, phase outs.
okay, the phase outs start. And it's essentially the top of the 24% marginal tax bracket. So for married people, it's like 320, I think now, or
Yeah.
it's like low 300s of taxable household income that triggers the secondary testing for Section 199A. So we're kind of geeking out. We're getting a little technical, but this is a big deal because if you do trip that secondary test now becomes 20% of your net business income or 50% of wages paid. And if 50% times 0 is 0, right?
Even in Canada.
Even in Canada, yes, absolutely. That math still works to our neighbors to the north. We have 20%, let's say, times $500,000, right? Let's say your business makes $500,000 after all expenses.
Nice.
That's $100,000 Section 199A deduction, right? But now we have the secondary test, 0% or 50% times 0 wages becomes 0. So you just got done taking a $100,000 deduction off the table because you didn't elect to be taxed as an S Corp and pay yourself wages.
Right.
Okay. So even in those jurisdictions where the federal tax savings goes away from a Social Security Medicare perspective, because all you're doing is taking money from your right pocket and giving it to your left pocket to pay Tennessee or New York City or New Hampshire. You might, like Joseph said before, optimize your Section 199A deduction. So just to kind of beat this down even further, just because you live in New York City or operate your business in New York City, New Hampshire, or Tennessee does not mean you automatically don't want to be an S Corp.
Right.
There are circumstances where it necessitates you to be an S Corp because of the Section 199A optimization. How about if someone has another W-2 job? Let's say this is just a side gig for them, right?
Yeah.
So they're making $150,000 at their consulting gig or their IT gig or whatever, but they also got this LLC on the side. How does that affect things?
So the savings are really going to be affected because if they're at 150,000, they've reached the limit for Social Security. For 2019, it's 132,900. So once you reach that limit, you're not paying Social Security tax on your net income anymore. It's just subject to the Medicare tax, which goes on forever and ever. So if they are already capped from the Social Security, their savings, decrease because that 12.4% for Social Security is just kind of gone now. So we have to work with that 2.9% with Medicare. So we'll need the net income from the business to be a lot higher than that 30,000 that we threw out earlier.
Right. And what the biggest drawback, right, is if you have a W-2 normal gig making 150,000 and then you have your LLC also making 150,000 and you're like, I should be an S Corp so I can save on taxes. Now you have to pay yourself a reasonable salary out of your S Corporation, right?
Right.
So for those of you out there listening who have changed jobs mid-year, let's say you work for Google through June and you made 150,000, and then you went to Microsoft and worked from July through December and made another 150,000. They will have both taken out the max portion for your Social Security wages for taxes, and you'll get the excess that you had to pay in refunded to you on your 1040. Unfortunately, Google and Microsoft in this example both had to pay 6.2% times 150, and they didn't get that money back.
Right.
Even though you got your money back for the excess paid in. So now you are forcing your S Corp, if you will, to pay a tax that it'll never get back.
Right.
By having to pay yourself a reasonable salary. So if you make more than the Social Security wage base, and right now it's 132.9, then maybe an S Corp doesn't make sense. There is a point, roughly 200 to 250,000 net business income, where the Medicare savings alone actually overshadow the lost or forfeited Social Security tax by your S Corp. Now, I might have blown away some of our viewers and listeners with that. That's okay. I get blown away myself when I start whipping out a spreadsheet and figuring out where the break even is for somebody. But at the same time, just understand that there is a time where still, even if you exceed the Social Security wage base, you still might want to be an S Corp with the side gig. And then we got the whole Section 199A thing all over again, all right? So anyway, there's multiple variables in there. We like things to be as binary as we can get them.
Right.
In these situations, they're just not, which is why people need proper consultation on this. We see too many lawyers just charging out making S Corps. We see too many people just charging out making S Corps. And then we get them and we're like, why are you an S Corp? You're actually paying more.
Right.
And then they're like, nobody told me. We actually had a guy that had 2 S Corps, and y'all know him. He had 2 S Corps, and he was paying himself a reasonable salary out of both that exceeded 100,000. So anyway, we saved him 7,000 just by saying, let's just move it all to 1 S Corp. So he was happy. Anyway, so all right, so that's cool. What about going concern? What's that all about?
So yeah,
that's all fancy accounting speak.
Right. Yeah.
Are you a going concern?
Yeah.
Taking me back to
Are you
principles
doing an
one.
orderly liquidation or?
Yeah, I mean, just the going concern is, are you going to keep doing this? Are you going to be doing this 3-5 years down the road? Is just a one-time thing? You got
people call us up all the time, like, hey, I made 200,000 this year. Cool.
Yeah,
I want to be an S Corp. Makes sense. How about next year? Oh, no. I'll make like 20 grand next year. This is just one time, one and done.
Right.
Okay. We can certainly explore that.
Right.
It might not be worth it to light the fire just to put it out for a few bucks,
Right.
you know? So, yep. All right, cool. So going concern, fancy accounting words. So how about the other one? We have to have an LLC or an entity in place. Amanda, can you speak to that?
Sure. So we kind of touched on that in the last podcast, which you all listened to. But an S Corp does not exist on its own. An S Corp is a tax election on an already existing entity, either an LLC or a corporation. And to create an entity, you need to register with your Secretary of State, either articles of incorporation or formation, or articles of incorporation, depending on the type of entity, and then obtain an EIN number from the IRS.
Okay. So how often have you gotten a call like in February where someone wants to do a late S election back to January 1 of last year? What's the very first thing you ask?
Do you already have an entity?
Do you already have an entity? Because
Was
we
it-
can go back and do some magic, like completely legal, legitimate IRS sanctioned magic.
Right.
But we have to have this entity, which is why we commonly say to people, if you're beginning a business,
Yeah.
jump out there and get that LLC going. It acts as the placeholder for going back in time and doing this S election. Now, there's some exceptions to that. We don't run out and do that in California, Illinois.
Right.
I'm thinking of somewhere on the East Coast, Maryland, I think, maybe Massachusetts. I mean, some of these states have egregious
Franchise
taxes
LLC
or
tax.
annual filing fees that just, you're like, why pay the money unless
Yeah.
it makes sense? So anyway, all right, so thank you, Amanda, for that. So you have to have some other entity in place. What about other partners, Joey? You kind of touched on this earlier.
I did. Yeah. I got a little ahead of myself, but
You?
yeah. I
Getting
did.
ahead of yourself?
Yeah. I know. It's pretty rare around here.
Yeah.
Yeah. So if you have other entities and you have to, because
Other
S
partners.
Corps, other partners, because S Corp split the profits based on ownership percentage. So if you've got a partner, if you're both insurance sales agents and you want to form an entity together, but you want to receive profits because you sell 70% and he sells 30%, then we have to do some dancing around the S Corp.
Conversation, yeah.
Correct.
So and we can discuss multi-entity arrangements
day.
all
Yes.
day long. Yeah, we should put that in the book. Oh, magical! It is in the book.
Weird.
Yeah, with a bunch of actually nice pictures. So check that out for those listening and viewing. No, but back up to Joseph's comment about an S corporation. Kind of put some handcuffs on you, right? It says, look, if you're a 50% owner, you must take 50% distributions if any distributions are to be had. Right. You can elect not to take any. That's kind of silly, though. Why let money pile up in your business? I mean, that's the reason you're in business, is to make money and pull it out and go spend it, right?
Right.
At least you should, or at least enjoy the fruits of your labor, kind of stuff. So if you going back to your insurance agent example, it's very common where insurance
Yeah.
agents, financial advisors, a lot of eat what you kill type of arrangements are saying, hey, look, we'll get together and we'll be 50-50 and we'll share this copier, we'll share this admin, we'll share the rent, we'll share whatever we're sharing. But at the end of the day, if I bring in 60% of the revenue, I want 60% of the profits.
Right.
And that might change from year to year. So you can't just lock it down and say, well, then we're 60-40 owners, right? 'Cause that might change next year. So you're 50-50 owners, you want a 60-40 split, or you have an angel investor who wants 50% of the ownership, but is okay with you taking 90% of the distributions. All those mismatched, capital versus revenue split arrangements or profit split arrangements, you can't do an S corp. Now you can play around, of course, with the wages, right? Okay, we'll still take distributions 50-50 because that's what our ownership is, and we'll just have a higher salary for the person that earns more. But at some point, that just becomes an unnecessary payroll tax
Right.
burden.
Yeah.
Right. So we can play around with it if it's like 48-52 and it's bouncing around
Right.
between tighter percentages. Once you start getting into the 60-40 splits,
Wider
you really
swing.
have to do a multiple entity arrangement. So we can talk about that again at a different podcast. Stay tuned. All right. And let's talk about this other thing. Oh, if your partner's your spouse, that's no big deal. Right. We're all we're all cool in the gang on that. We can make that an S corp and either pay both of you a salary or whatever.
Right.
So people come to us, they created their own LLC with their spouse just because that's what was done. that's easy. It's when the spouses are not, or when the partners are not married, when the members are not married, essentially when they're not filing a tax return together.
Yes.
That's when it gets messy. If you have a ownership that varies from your profit split.
Right.
All right. Does your entity own any appreciating assets? What's wrong with that one, Joseph?
So we typically don't put appreciating assets in an S Corp. Those are usually reserved for holding companies, and
Why is that?
well, should we get into the distributions of assets?
Sure. It's really quick and easy,
Yeah,
actually.
yeah.
Yeah. The reason why, if you were to ever not want to be an S Corp, let's say you had a hotel, right?
Right.
This is a real case example. It came to us, right?
Yeah.
We had a guy that had 2 hotels. His CPA revoked S Corp election because she was like, why are you an S Corp? This is passive income, rental income, passive income. Why do you have this in an S Corp? And she was correct. It should have never gone into an S Corp.
Right.
But once you do that, it's like the Roach Motel. You can check in, but you probably shouldn't check out because it's going to be very painful. That's a bad pun, actually. It's a hotel example. But anyway, so...
Or fortuitous.
That one was free of charge, everybody. Tip your wait staff. You're all week. But anyway, what happened to him was that they revoked S Corp election. When that occurs, all assets are distributed to the shareholders at
Fair market value.
fair market value, right? That's brutal. Okay, so this guy had 2 hotels. They were fair marketed at $2 million or so, 1.9. His cost basis, right? What he paid for them, all that was $400,000. So he had a $1.6 million capital gain,
Ouch.
which is cool if you got a $2 million check.
Yeah, it's a cashless transaction.
Yeah. So you have a cashless transaction with a tax bill. No thanks.
Mm-mm.
Right?
Pass.
And he asked, hard pass. And so he asked, like, what can I do? And I'm like, you're going to have to call the IRS and just maybe get a friendly agent on a Friday who maybe is retiring next week and just doesn't care, and maybe unflip the lever or something,
Right.
It's hard to reinstate S Corp election, and it's hard to magically make a revocation go away.
Mm-hmm.
You can sometimes do it in the same year. Anyway, there's a bunch of rules. Anyway, that was a mess. So we don't want to have, if your entity owns assets that are going up in value, I'm not talking about cars and equipment and all that stuff, we want to avoid that S. We want to probably do some arranging
Right.
of your assets and go, look, let's have, like you said, let's put the building, let's
A
put the
holding
warehouse
company.
in a holding company,
Yeah.
have it leased back to the S Corp, but the S Corp is purely an operating company. We actually see this with art and stock sometimes.
Mm-hmm.
An S Corp will own stock and other appreciating assets. Same mess,
Yeah.
Then what's really bad, we don't have to get too technical on it, but upon death of the shareholder, you don't get a step up in basis. But that's a podcast for a different day. All right. Amanda, talk to our viewers and listeners about this S Corp election. How do you do it?
Here we go. So there is Form 2553.
Which is her PIN and garage code.
Correct.
Right.
Everyone knows now. So again, you have to have an underlying entity, so either an LLC or a corporation that we talked about. Generally, the rule is 75 days from the formation of the business or from the beginning of the year, if you are making the election for that same year. Then all you have to do is fill out the 2 pages of Form 2553, have wet ink signatures from all shareholders.
Yeah, the IRS is getting all kind of mad about that.
They are.
We've been doing it for over a decade. We used to be able to do like those Adobe
Electronic,
signs.
it was great.
Where you had like the little time and date stamp. They let that go for many years. And then they're like, no, it has to be a real signature.
Right.
So we're like, okay, we'll just do like a DocuSign thing. And that flew by for 3 or 4 more years. And now somebody's like, no, what signatures?
So now it is wet ink signature. So we need to have that signature from all shareholders, and then we can go ahead and submit that to the IRS via fax. It usually takes them 8 to 10 weeks to process the application, which means somebody's looking at it, verifying information, and then mailing out a notice to you, snail mail. So you'll get that probably around the 10-week mark.
Okay. So when we do the S election, what else do we have to do? We have to get an EIN.
Correct.
Right. So sometimes people don't even have an EIN, which is totally fine. EINs are easy to get. We have to have that. If you have an LLC, single member LLC with an EIN, do you get to keep your same EIN?
Typically, yes.
Typically, yes. Yeah. There's only some times where you have to get a new one, and
Right.
it's So we have to get a new EIN, and the IRS turnaround time you said is like 10 weeks.
Yeah.
Sometimes the IRS messes up the date,
Correct.
right? Because they're a government entity ran by humans.
Who
Okay,
makes
so we're all
mistakes.
humans. Yeah, they're professionals too. So, what happens there? We get this letter back from the IRS saying you've been approved. Congratulations, April 3rd, and you're like,
Right.
we wanted January 1. What do you have to do there?
Well, sometimes you might get that if you formed your business April 3rd.
Yeah. Okay.
So you
People
can't-
do that all the time, right?
Yes.
They form an LLC April 3rd, and they're like, I'm going to be smart. I'm going to put down January 1. And the IRS figures that out.
Yeah, unfortunately, that doesn't work. You can't elect back before the entity existed. But
Which
if,
makes theoretical sense, right? You
Right.
want to S-select something that didn't exist until April 3rd? Okay.
Yes. Semantics. So if you do go ahead and fill out all the paperwork correctly and the IRS messes up the date, sometimes a quick phone call can fix it, depending on the IRS agent you get. If you are having your tax professional call on your behalf, then you'll need a power of attorney. We'll need a power of attorney,
Yep.
saying that we can speak to the IRS on your behalf. Sometimes it takes a little more, a letter explaining when we wanted the date, resubmitting the form with the letter, and then usually the IRS pushes it through.
So do you get more luck in Cincinnati or Ogden?
Ogden.
Ogden gives you more love than
It's
Cincinnati.
true, yeah.
All right. So note to self. Call Ogden.
Always call Ogden.
All right. Well, that's great. What's your success on getting some of that stuff done?
So I am proud to say 100%.
Okay. She's also quick to say, this is our lawyer speaking.
Yes.
Your mileage might vary.
It's true. So far, 100%, unless there was some kind of situation where there was a S Corp election that had been in place, then revoked. We didn't know about it.
Right. That happens.
Yeah.
What is your solution when that happens? Let's say someone's a consultant. They don't have any assets in their LLC. Their LLC doesn't have any brand, doesn't have any things out there, if you will. They say, hey, I was an S, I revoked S, now I want to be an S again. What's your suggestion in that situation?
There's a couple of different things that we can do. We could wait the 5 years, which is typically the
Yuck.
blacklist, right?
Keep talking.
Yes.
Yeah.
I know.
Let's go to plan B, please,
Yes.
right away.
Sometimes the IRS will let you go ahead and reinstate an S Corp election if there's a more than 50% change in shareholders.
Right.
So there's that option, or there's always secret option number 3, shut down your entity, start a new one.
Yep. Yeah. And that's usually going to be the easiest. And that, you shut down the entity. Yeah, that stinks. And you have to recreate one. Sure, that stinks too. You probably don't have payroll accounts going, I'm assuming, at your other LLC. So that doesn't exist. There's some expense with all that. Maybe you got to get a new business checking account, right? Because you got a new name and new EIN.
Different EIN.
All that stuff. But that seems like a smaller rock going up a much shallower hill.
Path
than
of
to
least
try to-
resistance.
Yeah, totally. So relighting a new entity is typically what we suggest to people that have a shutdown situation that's within 5 years where we can't. And then the change in ownership, that's pretty darn rare.
It is.
But if you do have a more than 50% change in ownership, the IRS says, okay, well, this entity is really kind of turning over, if you will.
Right.
We need to give the new owner, or at least a new controlling owner, the option to do an S election. Okay. But we don't, I've only seen a couple of those.
I think I've done one.
Yeah, in the decade or in the 12 years I've been doing this. So,
Right.
Okay. Well, cool. What happens when you do have a community property state? How do you list a shareholder?
So if it's a situation where it's a single shareholder, the husband or the wife, then we'll typically put the other spouse on and just list them as a 50-50.
Yep. Okay. And you have to have them both sign or just
Correct.
do one?
Both.
Okay. Yeah.
Yep, all shareholders.
What happens if you have 100% shareholder? Let's say, again, just to reiterate, the community property states are Washington, Idaho, California through Arkansas, all those touching Mexico, and then my favorite state, Wisconsin. Go Badgers. Tell me when you list somebody as a 100% shareholder, is the spouse required then to also sign?
Yes.
Okay.
The IRS does require that.
Yep, because it's a community property. They're making the assumption that the other individual could be affected by this, and they should be privy to this form and then eventually sign it. So
Yes.
all right, so we're running out of time. Does it make sense? I'm just going to whip through these really fast for everybody. Does your business earn over $30,000? That
Yes.
is because the cost of running an S Corp with tax returns and payroll and all that, has some expense to you. You want to make sure that the benefits are going to at least equal or exceed the costs. Are you located in New York City, Tennessee, or New Hampshire? If yes, it's not a hard no. It's just it's a maybe, or it's a no with a comma, right? There's a little bit of punctuation after the answer. Do we have other W-2 income that exceeds the Social Security wage base? If yes, again, not a hard stop, but we need some big income on the side gig now, so an S Corp can make sense. Is this a going concern? Is this a one and done, or are you growing your business? Okay. Most of the time, that's a yes, right? Do you have an LLC or other entity? Yes. Okay. Do you have other partners besides a spouse? The answer might be yes, and you might still split everything 50-50. Well, that's fine. But if you have a revenue split or a profit split that varies from the ownership split, then we have problems, right, under S Corp land. And do we own any appreciating assets like, I don't know, hotels that are worth $2 million?
Hard no.
Hard no, yeah. So what we want to do, anyway, we can talk about that later. That's another 30 minutes here. So anyway, my name, and then we talked about the S election within 75 days. We'll talk about a late S election, I think, next podcast.
Perfect.
That's a big deal. We also want to talk about late payroll events. We
Right.
also want to talk about 1099s in lieu of officer compensation on that late S.
Yes.
We got to talk about how, hey, we got this 10-week, 12-week turnaround time that's going to maybe push you past the S Corp filing deadline of March 15th. Now what, right? We have a lot of issues that we need to kind of hit on with the late S Corp election. We do a ton of those. Amanda does over 100, I think, over 120 maybe even this year. So it's easily doable, but it has some hurdles that we have to get over. So we'll talk about that in a different podcast. Again, thank you for joining us. My name is Jason Watson with the Watson CPA Group, joined by Amanda and Joseph. And join us, or I should say visit us online, WCGInc.com. We're going to have some other podcasts. This, if you're listening to this is also available on YouTube, which is exciting. We have a book that kind of outlines a lot of this as well. That's available online.
And what's that book's called?
It's a totally dorky name. Taxpayers Comprehensive Guide to LLCs and S Corps. And I regret every word. But that was a pamphlet title. Because, when you read a paper in school, let's say, you got these long titles,
Yes.
right? And then you try to cook it down to like something like Stephen King, like Christine or
It.
Pet Cemetery or It. Yeah, the shortest book title on the planet. Anyway, Taxpayers Comprehensive Guide to LLCs and S Corps is available online as well.
The S Corp word is good in that one. I like that word.
Yeah, the S Corp.
Yeah.
Available online, PDF format, also Amazon and paper and Kindle. Give us a call as well, or send us an email. We'll love to help you out and run through a lot of these questions on, does an S Corp make sense for you? It doesn't always make sense. I would say of the phone calls and emails that we get, I would say 1 out of 4, we say no.
Probably.
Come back next year, or no, it'll never make sense in your situation, or yes, maybe, but there are some challenges with I would say 1 out of 4. What do you experience, Joseph?
I'd say about the same.
Yeah. So we're not ones to pull the S Corp trigger. Right? We want to make sure it makes sense, not just today, but also tomorrow. So anyway, we can, again, go on and on about that. Thank you for listening. Thank you for viewing. And we'll talk to you real soon. Jason Watson, again, Watson CPA Group, Amanda and Joseph. Thank you.